Hey guys, how's it going today? Alright, so I'm back with another video and I'm really excited because today I get to talk about something that it's huge in personal finance, and we're talking about interest. Okay? What is it? How does it work? Is it good? Is it bad? And it's both, honestly, but it doesn't mean that it's confusing. But I really want to make sure that everyone understands how interest works because it is a very, very big factor when it comes to personal finance. So I'm going to break this video up into two parts. How is it good for you? How is it bad for you? And then go from there. I don't know how you guys like to take your news, but when I've got good news and bad news, I normally take the bad news first. So we're going to start there. All right. When most people hear the term interest, it's normally because they're talking about a loan. All right. What is the interest rate on your credit card? What is the interest rate on your car loan? What is the interest rate on your mortgage? Right? All these are loans from a bank and they all have interest rates attached to them. So when you take out a loan from a bank or a credit union, they want you to pay off the original amount that you borrowed, right? Let's say you borrowed $10,000 to buy a car. They want you to pay that $10,000 back plus interest, which is extra money that goes to the bank, right? That's how they make their money on loans, through interest. And how much interest you pay them is entirely based on your interest rate. So when you're taking out a loan, you want to make sure that your interest rate is as low as possible. Because if you do this, it means you're going to give less money to the bank in form of interest and save you money. So when it comes to loans, it's really, really simple. You want a low interest rate. The lower the rate, the less you pay. The higher the interest rate, the more you pay. So like I said, when it comes to loans, low interest rate. That's what you want. All right, so what we're going to do is we're going to make a little scenario here. We're going to pretend someone is buying a car. In one scenario, the person is going to do their homework, find a good bank or credit union, get a good interest rate on their loan, and see how much money they pay in interest. And then on the flip side, we're going to show what would happen if they don't do their homework, or if they go somewhere that gives them a bad interest rate, and find out how much interest they pay at that point. So let's take a look at that. All right, let's set the foundation. This person wants to buy a car for $10,000. They want to pay the car off in 3 years, and they find a good credit union or a bank that gives them 2% interest. Okay? And another thing here real quick, I don't quite want to show you how to calculate interest just yet. I will in another video, but for today's purposes, just understand that I've already done the math for this and I know how it works out. But in this example, $10,000, 3 years, 2%, this person will pay the bank $311.59 in interest. All right, so that means when you take the original $10,000 that he borrowed plus his interest over those 3 years, he paid a total of $10,311.59. This truthfully would be considered a pretty good loan. All right, now let's take a look at what would happen if that person didn't decide to do their homework or research, or they just went with a bad bank. All right, so that same person, let's say they did it $10,000, 3 years, kept those two factors exactly the same, but let's change it. They didn't get 2%, they got 10%. Now let's see how that changes the math. That comes out to $1,617.60, which means they really spent $11,617.60. That's a difference of $1,306.01. That's a pretty big difference. I don't know about you guys, but I do not want to pay the bank an extra $1,300 if I don't have to. All right, so this is just one example, and honestly, it's kind of a small one. You know, when you're talking about houses or more expensive cars or something like that, the difference can be tens of thousands of dollars. I'm not joking. So that was just to illustrate how interest is really, really important when it comes to loans and why you need to do your research to make sure that you are getting a low interest rate on your loans. Now, I'm not going to lie to you, what largely determines the interest rate that you get on your loan is going to be your credit score. And I kind of sound like a broken record player, but I don't want to talk about that right now. That's in another video. But for now, you need to know interest rates on your loans are not helping you. You want them as low as possible. All right, guys, we've got the bad news out of the way now, how interest rate affects us on loans and how it hurts us. Now we can go on to the good part and see how interest actually benefits us. So make sure you check out the next video. Hey guys, thanks again for watching this video. I hope you learned something new from it and you were able to strengthen your financial position. I'm going to keep coming out with more videos, so please stay tuned, but go ahead and like, subscribe, comment, and have a good day.